Hello, chart watchers, and welcome to this Thursday, February 7th, 2019 Market Watchers Live show with your host, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the bears have been waiting for a day like today. The Dow Jones Industrial Average currently down 360 points. The S&P 500 down 41, the NASDAQ down 129, and the Russell 2000 down 20 points. 10-year Treasury yield continues to drift lower. This is definitely problematic for equities, finally seems to be having an impact here. Volatility index last 2 days went down, traded below 16. Certainly not a good sign for the longer-term move to the downside, in my opinion, based on history. But today, the VIX is rising. You can see it is up 2.30 points today. It had closed yesterday at 1538. That's a big move on a percentage basis. Utilities and real estate, two defensive groups leading the market to the upside. Actually, I think these were the only two that were higher the last time I checked. To the downside, energy and materials both getting hit hard. You can see energy down almost 3% today. Big news in the banking space. SunTrust Banks and BB&T agreed to merge. I believe I read that will make the sixth largest bank with this combination, SunTrust and BB&T. It is an all-stock deal, so SunTrust will likely move in tandem with BBT. It opened up quite a bit earlier, but has moved down since the open. And Twitter was an earnings casualty today. So you can see the stock down more than, well, almost 11%. Big move down, threatening a low that was reached just a couple of weeks ago. We'll see if that holds. All right, Aaron, you have stuck firmly to your belief that not only are we in a bear market, but that we're going to turn and go lower. And looks like that's what's going on today. How you doing?
Well, one day it works that way, the other day it doesn't work that way. But, with the VIX as low as it had gotten, I don't think this is a surprise to too many people.
Well, I figured I probably helped out all the bears out there when I got stopped out for the third time trying to short the market. And was not in on the short side when this all hit. So for those of you wondering what's going on, you know, on the bear side, if you're making money, you can thank me.
There you go. Yeah, I've been tiptoeing in, but taking a little step here and there, moving out of cash. So, but I moved into all of those defensive areas. So today's a good day.
Yeah, I mean, definitely the defensive areas are certainly holding up pretty well. You can see the 10-year Treasury yield, as I talked about, still declining. So we know we got money rolling in there. Yeah, I mean, I have seen the dollar starting to move up here the last 4 or 5 days, and I think that's putting some pressure on energy and materials. But yeah, other than that, I mean, I think the market was due for a pullback. I think everybody recognized it was very overbought. And I put in my blog this morning that we were actually up almost 17% off the low. We were only 3% away from technically being back in a bull market. It's pretty good.
Yeah, I suppose you could look at it that way. I mean, we've seen some really good internal strength. It's hard to really argue with that. So I've been watching closely, and it's about time in my mind that we turn down. And wow, it's just falling fast right now too.
Yeah, I think there were a couple of things. I mean, obviously overbought, but then there were also some negative divergences on the hourly charts, which we'll get into in just a little bit. But before we do that, we do have a special guest that I would like to introduce into the show. He has been with us before. Obviously likes to share his Wyckoff approach along with Bruce Fraser. Roman Bogomazov, how are you doing this morning, Roman?
Tom, thank you so much for the introduction. I'm so happy to be here. Hi, Erin. Hi, everybody. And I'm looking forward to my presentation and to talking to you about the market.
Well, we are certainly looking forward to your presentation. We always have a great one when you come on the show. And your partner, Bruce Fraser, when he comes on, same thing, always a lot of fun. So we look forward to that. We're going to have you back in about 15 minutes, if that's all right.
Thank you.
All right, perfect. All right, Aaron, what do we got going? Busy day.
Indeed, as always, really.
Always.
Okay, so tomorrow we have What's Hot, What's Not with Mary Ellen McGonigal. She'll be in for me. Aaron's workshop. Oh boy, yeah, I haven't thought about that one. And then we have Rick coming in right after that on Wednesday. That should be great. We've had him on the show a few times. And then, yeah, let's see what we got what do we got today? Well, Roman, as we just introduced, will be with us shortly. 10 and 10. Our first symbol is going to be L3 Technologies, LLL. And then we're going to finish off with a segment called Momentum Sleepers, and stick around for that. All right, Tom, let's take it away.
All right, we're going to jump into the economic news. There wasn't really much out there, just normal Thursday initial jobless claims that came out, and they were higher than expected, 234,000 versus 223,000. Seemed like they just continued to go lower and lower each week, and we actually, I think, had one week where we hit under that 200,000 mark, but the last two or three have been a little high. I think after having one that was up around 250,000, this one too coming in higher than expected, so that's not helping the market either. As we've gotten so overbought in our major indices. But anyhow, let's take a look at what the 10-year Treasury yield's been doing with that little bit of weakness, economic weakness, I would say, although it's not huge. Still something for the bears to grab hold of. And you've got the 10-year Treasury yield rolling over and moving lower. You can see it down now today, almost 4 basis points, money rotating into Treasuries. And this, as I've said, is probably the biggest warning to me in the market is, I tend to pay a lot of attention to what goes on in the Treasury market. I think the Treasury market is smarter than the stock market. I just, through experience, I've seen when the yield goes one way and the market goes the other, the tendency is, not all the time, but the tendency is for the stock market, to play catch up to what's going on in the bond market. And you can see the bond market really not that far from the low we saw back at the beginning of January. So this could be very problematic for stocks as we go forward. But there will be some key short-term areas of support that we'll want to watch on the major indices. If we go rolling right through them like hot knife through butter, then we got some issues, I think, especially with the VIX rising like we saw earlier. All right, let's go into some earnings reports today. Number from last night and this morning. You can see them on your screen. Prudential, big miss there in terms of earnings, 244 versus 288. O'Reilly Automotive was maybe the most surprising because they did miss. They missed on their bottom line, as you can see there. So their earnings per share came up short. They also missed on their top line, lowered guidance, and the stock opened up $8. Sometimes you just sit back and scratch your head. But then you can see throughout the rest, there were some disappointments, like I mentioned, Prudential, O'Reilly. And then tonight, after the bell, you can see another list of companies that are going to be reporting. You're not seeing as many of the big, gigantic companies reporting. Most of them have reported, but now we're going into those second-tier companies that can really drive the market, especially the NASDAQ. A lot of second-tier technology companies and so forth that will be coming out with earnings, and you can see a list of those, and that just highlights them. Trust me, there are a lot coming out. Okay, so let's take a look at what's going on in the market. So first, I want to just go through and show you what I was talking about in terms of these negative divergences on the hourly chart. Now, a negative divergence occurs whenever you have price action moving in one direction, setting new highs. You get a negative divergence when the momentum oscillator does not corroborate that higher high. So you can see the higher prices on the S&P 500, but lower highs on the PPO. And that what I normally look for minimum is a reset. And when I talk about a reset, I'm talking about the PPO going back to the center line and or the price action moving back to the 50-day simple moving average. In this case, you can see we're just a little bit below the center line. We've moved below the 50, and now I'd be looking for some price support. So the S&P 500, let me show you the price level that I would be watching there. You can see clearly a double top, sideways action after an uptrend. We broke out, we pulled back, tested that area, and then took off. I would really be watching 2674, 2675 based on just price action. Now, remember that 2674 number, because when we go and take a look at the daily chart, and I'm going to pull up a daily chart, and we'll just do 6 months. But if I pull up the daily chart, the 20-day moving average is 2662. The price action, that price support level I just talked about, was 2674. Let's look at the weekly chart. Remember those weekly EMAs we were able to get up above on the S&P 500 and we're still above? It is sitting at 2674. So I'm looking at price support on that hourly chart, 2674, 20-week EMA at 2674, and then the 20-day EMA is at 2662. All three of those within about 0.5% of one another. I think that you're going to see more technical selling if we can't hold this level. So we still got a little bit of room to the downside, and I think just about everybody would agree that the market could use a little bit of a breather, but it could turn into more than that if we lose these levels to the downside. So we want to watch carefully here over the next couple of days, maybe even later this afternoon. Who knows the way the market's going down. Let's go back to that hourly chart, though, because normally when I see a negative divergence on one of the major indices, I like to see if it corroborates on the others. And if we pull up the others, the Dow Jones, higher prices, and actually it started to roll over right in here as we had these equal highs. You can see the PPO beginning to roll over, and then we lost that 20-hour moving average. How about the NASDAQ? If we pull up the NASDAQ, you're going to see similar situation, higher price, lower PPO, Russell 2000. The only one that I would say does not have the negative divergence, higher price, higher PPO, we never took out this high. But still, we did lose that rising 20-day moving average. So I think in the short term now with the weakness, you'd have to give a little bit of the edge to the bears for sure. The question is whether or not we hold that area of support that I talked about earlier. All right, let's talk about BB&T and SunTrust. Big merger here. I thought the banks would get a big lift, and I think early on the banks were doing much better than they are doing now. You can see BB&T after gapping up is moving lower. SunTrust, same thing, gapping up, moving lower. If we pull up the bank index, you can see that we had a slight gap up in the bank index, but we pulled lower, testing the rising 20-day moving average, also testing lows that we've seen over the past few weeks. So if the banks were to move back down below, say, 425, 424, that could generate some additional technical sellers in the banking space. So this is definitely something that we want to keep an eye on. All right, let's keep moving on. How about, let's go into some of these earnings reports. Just take a look at a few of them. MetLife reported. MetLife did come in, missed on their top line, missed on revenues. So they came in below Wall Street estimates on top line. Bottom line, they beat $1.35 versus $1.30. Market, though, not liking the report. And you can see on this chart as we were moving higher and kept trying to go higher, see the daily PPO rolling over. So a little bit of a negative divergence. I think that's going to bring the 50-day into play here on MetLife. Prudential came up well short on its earnings as talked about at the open. Here you can see the higher prices, the lower PPO. I think this is another one that looks poised perhaps to go down and test that 50-day moving average. O'Reilly, all right, missed on the top line, missed on the bottom line, lowered guidance, and is potentially breaking out to another high. Now, I didn't listen to the conference call, so maybe there were some other things here that I'm not taking into consideration. But I did see the top line, bottom line, and here we have a stock looking to make a new high with a monthly PPO that is still pointing higher. So O'Reilly has been one of these stocks that has been very strong. And if we pull up a relative chart, you can see that we had an uptrend followed by sideways consolidation. Now we're trying to get this breakout above the 360 level. And overall, this has been one of those stocks where you've got specialty retailers, which have done pretty well relative to the S&P. O'Reilly's done very well versus the S&P, very well versus its peers. And so this breakout would be pretty substantial, and I think bullish for the stock. Let's take a look at Twitter. Last one here. Twitter, you can see, actually, I'll take a look at two more real quick. Twitter, gapping down, really, really poor results here. They did beat on their top line, beat on the bottom line, but not the traders not really liking the outlook here and moving down. The question I have is, can we reverse and hold on to this level close to 31? So far, struggling to do that. Another report that was very strong, Chipotle. Chipotle, big breakout on their earnings report. They blew away the bottom line, $1.72 versus $1.41. I think there is some longer-term resistance that is around that 600 level, though. So let's pull this monthly chart up. Well, this reaction was 550. Actually, it looks like it's got open territory up to about 750 or so. So Chipotle could be a nice trade down the road. I mean, I don't know that I'd be chasing it after this big move today, but Chipotle on a pullback is part of that restaurant and bar area that's been strong. Okay, Erin, upgrades, downgrades, got a few of them. Which one?
I do have a few. Let's take a peek. All right, so I'm going to start off with our upgrades. First upgrade, BMO Capital, Cognizant Nisn't. Technology Solutions was upgraded from market perform to outperform. I thought this chart looked kind of interesting. I mean, we've got a PMO buy signal. It's going right there with that nice rally. Got the intermediate term trend model buy signal. But today's action and the failure to hold up here above 74, I think is a big red flag, especially when you look at how this area of resistance is very strong. Now, in the shorter term, we also have an area which should hold up as support, but it is not today. And we're currently actually trading under these tops. So I find that to be a problem. So given this, I wouldn't be upgrading it personally unless I could see it, maintain itself over 74. But, maybe BMO Capital knows more than I do. Yes, Jeffries upgraded this from a hold to a buy. And again, this one, it's a meh chart, I have to say. The good thing is, of course, you have the PMO turning up, but you can see it has been in a long-term trading range right here all year long, pretty much. And we're halfway up into it. So sure, I think you could look for a move up to that $25 area, get to the top of that range. But, in terms of a long-term investment, I would avoid it because we're just moving sideways. You're not going to get much out of that. All right. The only other upgrades we had today were PCAR and Spirit Airlines, at least the ones I thought were interesting for you to know. All right, let's move on to some downgrades. Marvell Technology. We got a downgrade from Craig Hallam from a buy to a hold. I see a downgrade in its future as a good thing. I would look for it to move lower. You have that PMO that is now topping in what I would say is very overbought territory. And this I thought was interesting. You can see it a little better in the thumbnail, but we had a symmetrical triangle going here. And we got the breakout to the upside, which is what you would expect. It's generally a continuation pattern. Got that nice breakout. And then today, that turned out to be an island reversal. We ended up with a gap down, and we're now trading just above $18, which is, so for me, when I see a somewhat bullish pattern and it fails like this one did, and you've got a PMO that's turning down, I would certainly not be interested here, even though we do have that buy signal that came in on the intermediate term trend model. 50 is still well below the 200. All right, Omega Healthcare. This one was downgraded by Stifel from a buy to a hold. This one I'm seeing a short-term double top. And if that executes, of course, that is going to bring price below this area of support right there at about 38. And you should expect a move down to at least that 36, 35 level off of that double top if it does execute. And looking at the PMO, I would say that it likely will execute. Owens, Illinois. We also got a downgrade for B of A Merrill, downgraded it from a buy to a neutral. All of these downgrades actually are moving from, the positive bullish buys just into neutral at this point. So while these are downgrades, they're not, as serious maybe as if you were going from a neutral position into a sell position. But in general, I mean, all of these downgrades, I think, don't look good. I think they're pretty much right on. I mean, we have a PMO that's just about ready. Actually, it is currently logging a sell signal right now. In overbought territory. And you've got, of course, the breakdown below what should have held up as support right here. And it did not. And the only thing I think right now that's holding it up is that 200-day EMA. And I wouldn't be looking for it to hold up much longer. It's too bad the 50-day EMA looked like it was ready to cross above the 200, put us in a bull market situation, but looks like that's failing. I would look for lower prices. I think that downgrade is certainly warranted. Vale, V-A-L-E, was downgraded today by Morgan Stanley from overweight to equal weight. And I have a 5,200-day negative crossover getting ready to occur today. That's a long-term sell signal for our trend models, and you don't want to see that. And right now it's sitting right on that support level of what we got at that low in January. This one's trading a pretty it's a little bit volatile. I personally wouldn't have been involved in it anyway. Right now, and it's on the downgrade. We are at some important support here at about $11, but I just don't see it holding. And that's all I had for the upgrades, downgrades. The downgrades that I didn't go through, Fortinet, First Data Corp, I think that was its second downgrade this week, and FireEye were also downgraded. And that's all I have. So let's go ahead and bring in Roman. Very excited to have you here to talk Wyckoff. Everybody loves it when you or Bruce come in. So without further ado, I'm just going to say, take it away and let's go.
Thank you, Erin. And hello, everyone, again. I'm really happy to be here. Today's presentation is going to be about the current market price structure. And it seems that I come on the show at the very interesting times. Last time I've been on the show, I was heavily short, and I was shorting the markets, with stocks like Novadia and Apple. Novadia worked out really well. Apple was not the greatest trade that I had, but still, directionally, that was a good call. And now today I'm coming in on what seems to be a short-term reversal call that we probably will be making by the close of this session. We definitely need to see how the intraday picture is going to unfold, how the daily close is going to show. But from the intensity of selling that we have from this morning, it seems like we are going into a reaction. I'm going to say that this is a short-term reaction. And usually when I talk to my students about some kind of market action as a reaction, we want to understand that we need to make a judgment as to the quality, the character of this reaction. Is it going to have more of a bullish quality or bearish quality? So we'll talk about this. We also will talk about the long-term picture, how do we view the whole market? And I'm just going to kind of like, spoil this poll question right away. I'm just going to say where I stand on this. I think that we are somewhere in the middle. We are not in the uptrend, but we are not in the downtrend either. I think that we are in the very prolonged consolidation in 2019 is probably going to have more of the trading range type of qualities market. So with that, let's go to the first chart and just grabbing the drawing tools. We're looking at the long-term picture of S&P 500, and we're looking at S&P 500 from the lows of 2009. And usually when I put one chart with one scale or another, usually students go and ask me the question, well, you put the logarithmic. Well, what about the arithmetic? You put the arithmetic. What about the logarithmic? So here we go right away to erase all of the questions from your minds, both scales in front of you. So look at the trend. What do you see? What is the long-term trend? It's still up. No matter how you're going to view it, no matter what your definition of the long-term trend, we still have higher highs, higher lows. The price is contained within a long-term channel on both scales. So we do have spots where we have short-term oversold conditions. Those are usually cyclical lows within the context of a much larger secular uptrend. Now, there is a lot of talk in the media about, well, it's been a while. It's kind of like the uptrend is going on the year number 10. Well, think about the runs that we have had since the lows of 1982 into the highs of 2000. That's 18 years. How's that possible? Well, there are markets like this. There are secular uptrend markets that are going to have very significant cyclical lows like 87, 89, 91, 94, 97, 98 before we actually hit the top. And those could be quite significant. Those could be 15, 20% within the structure of the overall big market. So that is the first question that we want to answer today. The second question is, let's say that we're kind of like exploring a bullish scenario. How would the price structure unfold from this point on? What we're kind of claiming today that maybe there is a daily reversal that we are anticipating by the end of the close of today. And maybe that will produce what Tom has mentioned, a technical rally, which I really like as a definition. So do we have enough space within the structure of the current up channel to have that type of technical reaction? Well, we certainly do, especially if this is a higher low. Then it doesn't really need to be violating the support that much. And we also know that we could be in some kind of oversold condition going even with that reaction. So until it actually decisively breaks the long-term trend, tries to rally on a weaker rally, and then goes down, confirms that move to the downside, I think the long-term picture is still under question. Meanwhile, short-term, and I'm going to show you on the intraday, yes, we would be expecting some kind of reaction. And as Erin was saying, like, this anticipation that the reaction is going to happen was pulling a lot of traders to put on the short positions. And I'm going to show you one of the analogs that we used in our classes to address this rally. One other point here that I want to make on this particular chart is, if we are in some kind of consolidation, what would be the duration of this consolidation? So looking at the analogs of this same secular uptrend and looking at where cyclical lows in the oversold conditions were formed, and looking at the duration of those formations, we kind of see that sometimes it takes some time to take the new high. And during these times, we are going to have pockets of high volatility. Well, don't we see the same picture here? Kind of, we do. So it all depends on what kind of reaction we're going to have. Is it going to be more of the bearish market type of reaction, where we're going to create a new lower low, or is it going to be a bullish type of reaction where a new higher low is going to be created relative to the low in December, and from there we might rebound again? All right, let's go to the next one. And let's check out, the breadth and the momentum. And there is a lot of talk about that too. And I think it's a correct conversation to have. Is the rally that we're having currently, that we're in currently, does it have enough momentum? Is it healthy enough? Is the overall market participating in these rallies? And to look at the analogs that preceded this type of rally, this type of action, we have to go to 2016, and we would see that on the rate of change, we're having momentum kickoffs where institutional buyers are extremely active, and they are initiating their positions, accumulating the stock for the next run up. In 2011, the same thing happens. Momentum kickoff. This is where, again, institutional buying is very aggressive. They are coming into the position in anticipation of a big move. Well, on the momentum side, we definitely see that we're there. We have overcome intermediate highs. It suggests that institutions are buying, and the questions here is why they are buying. Why we were thinking that this is a bear market, and yet they find value at this extreme short-term oversold condition. Well, maybe they're, again, concentrating on the economy, concentrating on earnings. This is what's most important to them. In my conversations with institutional managers, and that is the theme that comes up constantly. Any bearish arguments that I have for them is being countered by, look at the economy, look at where we are. We are not necessarily growing at the same rate as last year, but it's still a relatively high level for the U.S. economy. Plus, U.S. is just definitely outperforming a lot of other economies. So the breadth and the health of the market on this rally, and I think Erin has mentioned this, is pretty good. All right, well, let's look at the analogs. This is the analog that we started using somewhere here after the test. This was one of the analogs. We were looking at the bearish analog of 2000, 2007, and that failed. Once the analog fails, you have to find something else. So there are two analogs that I found for our students. One of them is actually Tesla. Tesla in 2014, 15, 16 has been in a very interesting position. It almost seems like the long-term growth of the company was on the table. It was there. Everybody knew that, you know, the company has a lot of potential. But yet short-term problems created after a reaccumulation texture environment where we have diminishing downspread, we have diminishing volatility that produced the rally into the upthrust situation. But then after that, we have distributional qualities where supply is coming in, where the result to the downside is expanding, and that led to a short-term downturn that turned out to be a shakeout. Does it look familiar with the markets that we had since the beginning of 2018, where we had that type of reaccumulation type of texture with absorption elements, then short-term distribution, and then a shakeout? What happened afterwards in Tesla? Well, institutions are seeing this as an extreme value. Also, there is a lot of liquidity at the bottom of this shakeout, and they are buyers. They are aggressive buyers just based on the long-term picture. So in a way, that's kind of like how I view the U.S. economy. It's just long-term, it still has some potential. So I think institutions are not easily giving up on their positions. Now, this analog is very similar to what we've experienced in the Dow Jones Industrials in the 60s and 70s. Look into the Nixon shakeout, the Watergate, and then the rally that we had out of that. This is a very aggressive rally and very sharp rally. By the way, Tesla, in 2 months, rallied to the resistance. And that's a very short period of time to travel so much in such a short period of time. So looking at what we have in the current structure, a shakeout that leads to a smaller trading range that has all of those reaccumulation attributes and attributes of absorption. An upthrust, something what we've experienced in both the Dow Jones Industrial and Tesla. And then a distributional pattern that leads us to a short-term downturn that is possible shakeout action. Why do we talk about the shakeout? Well, if we would have an automatic rally, automatic response out of the climactic condition, and then the price would stay here, that would look more like 2007, 2000 type of market where the rally is so weak and it cannot travel back into the trading range. This is a different animal. This is a different type of rally. It's very strong. It came back into the trading range. It came back to about 1/2 of the height of the range. So that tells us that a bearish scenario, even if it's going to unfold, it's going to have a different structure. All right, let's go to the next one. Well, let's look at the way how the Tesla analog acted on the intraday level. And I want to point your attention first to the volume signature that suggests that the volume increase suggests institutional buying at this extreme oversold condition. And look at the rally. It doesn't have big reactions. All of the reactions are kind of the same quality, muted, and only when we go into the first overbought, overthrown condition, we produce some kind of change of character that produces the reaction of a larger magnitude. Yet, we're still going up after the consolidation, and this is the area where we start developing some kind of volatility. We see this from the price action, we see this from the volume signature. So usually that would indicate institutional selling. So we had the buying at the bottom, we have the selling at the top, and this is how this pattern has failed to continue to the upside. And this is exactly what I'm expecting to happen with the markets. So initially we have the volume increase around the lows, around the Christmas lows, and that suggests that there is some institutional buying. There is a lot of momentum in the first two rallies, so that also suggests buying by institutions. And then the rest is just a continuation of this rally. Well, what recently has been happening on the intraday picture is that the latest rally out of this consolidation, and look how everything kind of repeats in this analog with the overbought condition and then a non-trending environment, the momentum started to go down. So that was a precursor for the potential reaction. So we have today a slightly increased volatility. I like how the supply is coming in. So this means that there is some more institutional selling that we see in this. And obviously that comes after the slowdown and the momentum. So that suggests the reaction. That suggests kind of like the timing also for the reaction. All right, let's look at the next chart. So here, the questions that we need to address. What is the current bias and what is the current Wyckoff labeling? So let's start with the very long-term bias. The long-term bias, as I have shown you guys, is still up. I don't think that anybody can convince me since the lows of 2009 that we are still, we are not in the uptrend. We're still in that uptrend. The intermediate bias is a trading range. And I think if there is anything that you can take from this presentation, I would like you to take this. I would like you to think about how the structure unfolds here. I mean, we are obviously staying within the structure, within the confines of the support and the resistance, and we could have different lines here. We could extend this trading range, the height of the trading range, and we definitely see how we were in the extreme oversold, extreme value proposition spot. And we came back. So we are still in this formation, in this larger formation. So that gives me an idea that intermediate bias is just a consolidation. And then the short-term bias, and I was preparing this presentation yesterday, so the short-term bias is to the upside. That's a predominant short-term bias even for now. But today, as I mentioned, and it's just so funny how I come up on the show and something like this happens all the time. I think that we are actually very vulnerable to violate the trend line today. If we're going to close below it, we probably going to have the reassessment or institutional reassessment of the short-term picture, and that should produce some kind of short-term capitulation. This capitulation could look like a big bar to the downside. We would call this a change of character bar. What are we changing? We're changing one environment, an uptrending environment, to the next environment, which could be just either a larger consolidation with the short-term bias to the downside. So I'm going to kind of like maybe even cross the uptrend here, and I'm just going to say that we maybe are going today into the short-term downtrend environment. And that would be healthy, by the way, in any environment, in any structure that we would be. It would be healthy in the trading range environment, in the bullish environment, and in the bearish environment as well. I put some targets here that at this point I'm doubtful that we're going to reach. Also, please note that we came back to the institutional value zone. That value zone was created by the buying on the selling climax into the lows of February, absorption around April, May, June, and then attempts to stop the downtrend in the same place. So this extreme oversold condition on the terminal shakeout produced that value for institutions where they just were starting buying, and look where it stops. Look where it's going to react, if it's going to react here. Again, they brought it to the value zone and they're saying this is where it should be. But as always, the short-term moves produce a change in sentiment. So from extreme oversold condition, we're going to the overbought condition, and that suggests a reaction. So we kind of bound to have the reaction, and the biggest thing is to understand what kind of reaction we're going to have. Are we going to have a more shallow reaction, which is still a bullish scenario with the higher test? We are just basically expecting a test of the previous low. Or would we have more of a lower test, more oversold, short-term oversold? And there are still spots where you can go and still could have a consolidating and even bullish environment after this. So that's why it's so important to understand the quality and the character of the next reaction. Another analog that I like at this point of time is the analog with Apple. look at the distributional top that we have in the S&P 500, just recent top, and we're using the reversal, three-box reversal traditional scaling. The same happened with Apple before it had a big shakeout. And look how this catapult wall down is so similar to what Apple has experienced. Came to the lows, came to the previous lows, and then very sharply is going up. Very sharply is going up. So there is some institutional buying off this low. So one of the scenarios which is still bullish, this was 2016 trading range for Apple, where Apple consolidated and then went up. So in this scenario, the price came back to the lows of the climactic action and retested those lows. So, but it went down in a different way. It was having some kind of capitulation, and then after that, every next down thrust was diminishing, suggesting that there is some buying on the way down, absorption on the way down. So that's why I'm still thinking, even if this scenario unfolds with the market, we're probably going to be still in some kind of trading range for 2019. So that poll question that I had for you guys, I'm seeing that a lot of you are with me. You kind of saying that we're going to be in the middle. We're going to be between the highs of September and the lows of December, which I actually agree on. Okay, so how would a bearish scenario unfold for those of you who are bears? So imagine if this reaction is quite significant, and the character, and this is going to be extremely important, and the character of this has a lot of bearish characteristics, and the price goes actually to the lows, and then after that has no ability to come back to the higher structure and creating lower highs. That would be a signal to me that there is a deterioration of the price structure, and especially if it happens on increased institutional supply and reemergence of volatility. And by the way, this reaction, that's going to come, it's going to have some volatility, because a lot of people are going to be thinking and emotionally remembering the latest decline that we had from September to December. They're still going to be vulnerable, to act on that. Having said this, I'm telling my students that you gotta look on both sides right now. You gotta look on the bullish side and you gotta look on the bearish side. And usually, I would say this only when I'm expecting some kind of trading range environment. And also, I want you to be extremely selective in your time frame. Whether you're initiating a very long-term investment type of the position, you have to be aware of all of the elements that should go into that selection. Or you're swing trading, then I would prefer you to look at selection on both sides, especially in this type of market. So how would the bullish scenario path would unfold? We definitely would go into the overbought condition. We would experience some kind of change of character, maybe a reaction, and then some kind of consolidation. That would be the bullish path. So we could spend a quite considerable time here in 2019. So my performance expectation for the market is in the single digits, but still profitable. It could be, something ridiculous as like 3, 4, 5%, something like that, or even close to the break even. But I'm still expecting that volatility is going to go down, and we're going to have some kind of consolidating action. All right. So then the last bonus question, number 11, and I'm not sure how much time I have, but I want to go and show you some of the stocks that I'm looking currently at, and I'm gonna go really fast. Do you guys see my screen? This should be.
Yeah, we got you.
Yep. Okay, great. So I was looking yesterday at the media agencies at our Wyckoff market discussion class that I conduct with Bruce. And for those of you who would like more information on this, come to our website, wyckofanalytics.com, check it out, request a free access to, a session. I'll gladly do this for you. And just, it's always a constantly discussion about the market. So in looking at this yesterday, we were talking about a consolidation. And then, what has happened yesterday and what's happening today on the increase in supply signature with the deterioration and divergence that Tom was mentioning. Look at the price, higher high, and then lower high, and the momentum is giving us a different reading. So that type of divergence that I also don't like. And the way how it creates the lower high and then just pushes everything down is very peculiar. So what kind of stocks and you would be looking for in this type of sector, in this type of group? Well, the ones that climacted were trying to go up on multiple attempts where you have increasing effort to the upside, and yet it produces just an attempt to upthrust. Very bullish sign, looking visibly bullish bar, but yet nothing happens after this. So this is a failure. Another sign of weakness into the commitment below the support, and then inability of the price to come back to the resistance. And then on the increase in supply, we are dropping down. So let me just quickly go through this, and maybe I'm not going to use my my pen here. Fixed line telecommunications in the downtrend. So you want to find the stocks that are going to be in this group that are going to exhibit the same type of the characteristics like AT&T, and look at how we are stepping down with each of the consolidation. Look at the moving average. I'm using different moving averages here. 252 is a year moving average. 63 is 2 quarters. That is just an institutional reference. And 21 is the monthly moving average. And again, on the rate of change, we have the new high, and yet the price is showing a lower high. Divergence, not something that I like. Investment services, think about the market structure for the whole 2018. What kind of returns investment services could provide? Not a lot, so that's why we have lower highs, lower lows, oversold condition that produced a technical rally, but look at where it comes to. It comes to the resistance that acted before as the support. So also not that attractive. How would we be trading something like this? Well, we want to find stocks that are already in the downtrend in this group, that are exhibiting short-term weakness, and something like E-Trade with the lower highs, lower lows, suggesting that at least we're going to retest 40. Maybe we're going to go to 36 and be still in this kind of like expanding downtrend. Intercontinental exchange, what seems to be a leadership. And this is such one of my favorite patterns. Leadership distribution that has reaccumulation characteristics going into the upthrust with the change of character and then an ability to rally. And look how nicely this shorter term upthrust unfolding. And today it's just a lot of selling. So some of these stocks that were leaders are becoming laggards. Look at another one in the same group, CBOE. Well, that one is probably one of my favorite charts right now as a short position. We cannot lift here after we've created multiple lower highs and lower lows. This is an element of a distribution. This is an element of the poor demand. And look at the momentum signature. Lower high again, and the momentum is not that strong. This is such a great candidate, to look for a short. CME, Chicago Mercantile Exchange, another leadership stock in the same group. But yet, as the market was rallying, what are we doing here off the December lows? Nothing. And these are the stocks that we would want to look for our short positions. Long positions. I really like Erin's idea about utilities as a defensive and as also, stocks that might appreciate in this environment. If we are going to have a bear market or continuation of the bear market, these are great. If we are going to have some kind of volatility, these are great. I'm looking at the water as a group in general. In there, look at some of the stocks. American Water Works, just an uptrend. December shakeout is within the structure of the uptrend, and yet it just recovers so quickly. Look at Aqua America, kind of the same pattern, maybe a little bit weaker, but still ability to stop the downtrend both in October and in December, and then coming back into above the short-term resistance. Another one that is conventional electricity group, and kind of the same pattern because of the same theme, right? Flight to safety, flight to quality. And in there, something like Axel Energy, already overcoming the long-term resistance, creating a commitment above that resistance, reacting within the market in a shakeout type of manner, creating institutional volume behind that reaction, and then coming back really quickly above that resistance. That's very bullish. Another stock in the electricity group, well, this one has been a leader for quite some time. And these are the ones that on this reaction, and this is very important, I'm not suggesting to buy here. This is an overbought condition. I'm suggesting for you to look at this stock during the next reaction and to define what kind of quality of the reaction we're going to have for a leadership stock like this. And then into more regular themes. Let's look at some of the themes that, and I'm going to try to be quick, that could be potential longs after this reaction. Well, when I look for longs right now, one of my requirements is the rally overcoming the previous point of selling that we have had in the market. And aerospace is one of those groups that did exactly that. Look at the momentum. It's a significant run. Look at the volume confirmation. Volume increases. Institutions are coming in. They are eager to get into this position. Yes, we are vulnerable for the short-term reaction, but these are the stocks that I'm putting on my watch list for the next potential move up. Another stock, the stock now in this group, what would be the stock, right? So Boeing has all of the characteristics of comparative and relative outperformance. It's still in the long-term uptrend. Look at the long-term moving average. Look at the momentum that it has created on this rally, and more importantly, above the market, above the group, it has created the new higher high. And that suggests strength, that suggests leadership, that suggests that institutions are not willing to sell at this point, and they're willing to hold on to the supply of the stock. So we are waiting for some kind of backing up action, some kind of reaction that is going to be much more favorable than the reaction of the market or the group.
Roman,
yeah.
I got a couple questions. I want to make sure to those questions in the room, but before we get into those, I was wondering because you got TDG. This is actually the stock I was going to ask you about, which is pretty funny.
White Witcher.
Yeah, but we talked about the aerospace group yesterday on the show.
Oh, great!
This was one of the areas that I thought really looked good within the industrials.
Yes, I agree.
I think it's pretty cool that you're kind of going in through the same group and looking at it from a Wyckoffian perspective and seeing some of the same things. But TDG was the one I was going to ask you about to maybe take a look at, and then we have a question or two from viewers before we get into the poll.
Excellent. What was the question about TDG?
Well, I was just wondering if this was, given your review of it from a Wyckoffian perspective,
right?
This one as good or maybe even better than Boeing in the aerospace?
I like both of them. I like Boeing more, kind of like on the longer side of the position, because the causality in Boeing has been quite significant. So when we look at Boeing, we are recognizing that the trading range has been developing for almost a year. So that's a sizable cause for us to produce a sizable swing to the upside. So I would be really anxious to see what kind of reaction we're going to see here in Boeing. It's one of my favorite stocks right now. So is Digm. Why? And we actually had a session with Mary Ellen. We invited her to our Wyckoff market discussion. She was the one who brought up this stock. And in preparation for that session, we were discussing this, and I'm like, this is one of my favorite patterns. What is so great about this pattern? Well, look at the trend. We're judging the trend by the moving average, long-term moving average. It's up. Look at the February lows, March lows. They did not produce a significant reaction below the previous support. More importantly, the leadership has still been intact on the rally after that. We're significantly outperforming the market with the move to the upside. And then more recently, October low, December low, they are more subtle than the market. They are not creating lower lows. So that's a very good pattern. And then we have at the end of it, an absorption where supply has been diminished so much throughout this whole structure. So Tom, this was one of this kind of like my pattern for swing trading, for short-term swing trading, and that just was a really good candidate.
Well, now, I mean, if you're looking at this chart now, obviously it's made a huge move. Would you even begin to initiate a position at this point, or would you have to see a little bit of a move back?
There is no reason to do this right now, right? For two reasons. Why? Well, we are in the short-term overbought condition here. That's a just a reaction. Plus, and this is what students forget about, the market. Think about what the market is doing. The market has so much force, so much gravity, that it basically moves everything with it. Just think about like big celestial, bodies, out there. They have so much gravity that they, we kind of bound to their movement. So the market, I look at the market the same way. So these two components suggest that you just have to wait.
Okay, cool. Very good. All right, before we pull up the poll, there's one question that came in and asked, how can you tell, you were circling volume and saying institutional buying and selling. How can you tell that it's institutionals?
Sure. First of all, for this type of questions, come to our website, check out our flagship course, which is Wyckoff trading course. I teach 15 sessions in that course, and we go through all of the details, nuances of the analysis on institutional buying and selling. In this example, very quickly, we look at the volume signature and we look at what the price has done. The price has stopped going down on the increased volume signature. So we are suspecting that supply has increased at this spot, but so has demand. Why demand has increased? Well, because of the stopping action. So somebody had to come in and to absorb the supply that was available. Well, who would do that? Well, only institutions can do that at the point of fear. Weak hands will be capitulating at this point. Weak hands will be giving up on their positions at this point. That's the nature of their behavior. Institutions are going to seek value. In where? They're going to seek value in the leadership stock, especially during the market's reactionary lows. So therefore, this type of signature is of institutional type. And what do they do throughout this whole range? They are buying. They are buying. They are buying. They are buying at the low. All of these lows are showing us that institutions are buying. They are buying less throughout this whole trading structure to the point where supply has been so exhausted and where they don't have to buy. And usually after that, there is some kind of anticipation of the event that was earnings. And on earnings, you're going to have more institutions and more participants changing the sentiment and coming into the position, and that would produce that momentum that we see on the earnings day. Tom?
Yep, excellent. Another point maybe to make too is TransDigm. When it fell back in December, it did not break below the prior low, even though the S&P 500 broke by a mile, and so did the aerospace index as well. So
absolutely
good relative strength there for sure. All right, we're going to bring the poll up, and while the poll is up, there was one other question, and the question was, Ramon, since you expect single-digit gains for 2019, do you think we've already hit the high for the year?
I would probably be inclined to think this way, just because I think that the bearish sentiment is still extremely strong. So this reaction is going to kind of like have this sentiment of, oh my gosh, see what's going to happen, and that's going to produce a lot of anxiety with institutional managers, and some of them are going to, trim their risk, and they're going to start selling again. So that's going to produce some kind of short-term volatility, and that will establish the high as kind of like an intermediate short-term high. I would not be expecting that we would, go up above this high right away. So there's going to be some time that we're going to consolidate. So hopefully we're going to consolidate actually into September, October, November lows. And then out of that cyclical seasonal low, I'm expecting that there's going to be some kind of rally. I'm not sure if we're going to overcome in such a short period of time, in let's say November, December, the high. It's possible, but that's kind of like the scenario that I'm looking at. So maybe like 60% of the consolidation, and then with the possibility out of the seasonal low for a good rally.
Okay. All right, well, here is the result of the poll, and you can see 51% are saying that we will finish the year somewhere between the September 2018 high and the December 2018 low. I am going to go with the second choice. I think we go back and break out again later in the year. I think it'll be in the fourth quarter. I agree with you. I think we're going to consolidate. Typically, the fourth quarter is very bullish. I think by the end of the year, we're going to break out above the September high. Just my call. What do you think, Erin?
I was looking at it. I'm bear market mode, so I considered the below the 2018 low. But my sense is that we're going to go through this decline, and the bear markets usually don't last as long as bull markets do. So I think we could certainly get back in above that September high by the end of the year. I don't think we're going to see that for a while, but we'll see.
Okay, cool. Well, Roman, it was a pleasure to have you on here again. Really appreciate your take on the market. I think a lot of it makes perfect sense. I think our viewers probably would agree. And we look forward to having you back on the show soon and take another look at the market, see where we are in a couple months.
Thank you so much. Invite me on the next reaction, please.
Sounds good.
Bye-bye.
Thanks so much for stopping by. All right, Erin, it is time to move on. So we are going to go straight into the 10.
Yes, and you have your first one, and there's a tie in the room, guys. You need to like those symbol requests so that we can get it on as a second one.
Okay, let's pull it up. So we're going to start with L3 Technologies. This is in the defense group. The defense group, you can see, has actually started to move off of that December low like the overall market. But the one thing I just wanted to point out here with L3, because we're going to go through this rapid fire, but I do like the fact that this is one of the best stocks in the defense group. So if we continue to trend higher in defense overall, you have one of the leaders here. I would just say, maybe watch this 191 to 193 area. That's where we gapped up. We pulled back, had some buyers coming in. So I think short term, that lines up right with that 20-day moving average.
All righty. So the most popular one, we still had a tie for three of them. So I'll cover, actually, no, people just, boom, came on in. The most popular is SQQQ, which is the short, Ultra Pro short for the QQQ.
All right. Well, first, I can probably just put this on a regular chart. Well, it's going to be the flip of the overall market. So the overall market, I was talking about wanting to make sure that the 20-day moving average holds as support on the downside. So I think what you really want to pay attention to here is whether or not we can get through the 20-day moving average, which is going to act as resistance on this since it's an inverse fund. So those are definitely the levels I would watch. If we can get back through the 20, that could be problematic for the overall market, but obviously that would be good for the SQQQ because it is an ultra pro short.
Okay. Next one up is going to be Alaska Air Group, ALK.
All right, ALK. Well, it isn't a flag, so let's see which way it breaks out of this. Volume is dwindling, so I do think we're going to probably have a big move here shortly in one direction or the other. 63 to 66 is your key area of resistance and support as we've come up out of this move to the upside. So let's see which way it goes. If the market, is weak, and you can see ALK has really not gotten a whole lot of the losses back from that December, late November high, big move down. This reaction hasn't been great, but it is sideways consolidating after an uptrend. Let's just see which way it breaks and then go from there.
Okay, next one up. Let's see. Glaukos Corp. It's a healthcare medical equipment industry. GKOS.
Yeah, I think this one looks pretty good. The only problem is that it's hitting resistance. I'm going to pull this one up on a relative chart. You can see, first of all, medical equipment. has been pretty strong. I mean, when you look at medical equipment relative to the S&P, it's been strong. Glaukos also has been strong relative to the S&P and relative to its peer group. You can see the triple top there along with price action triple topping. So I think those are the two key lines. I mean, if you get a breakout above this area and also on a relative basis above that level, it would be hard to argue against this position.
All right, let's see. Are you loco for El Pollo Loco? LOCO.
Yeah, this is a good one because there was a question in the room yesterday asking me what I did with this stock. And I just didn't manage to get to the question yesterday because I owned this one. In fact, it was my setup for this week. I got stopped out yesterday on a close below the 50-day moving average. So I had two entries on this. I'd gotten in, I think, right at around 1610-ish, something like that. And I also bought on the 50, and when it closed below the 50, I got out. So that level right there is a problem. Now, I still like the stock, and I like the group. I mean, I could go back and let's just pull this up. Hold on one second. Let me, yeah, this trend line, I mean, if we go in here and just connect these lows, I mean, you can see that there's still a really nice trend line in play. I'm only giving up on the stock in the short term, not in the long term. So if it continues to drift lower and eventually can work its way back down to 14 to 14 and a half, I think the reward to risk would really be solid down here near the support level, both price support and trend line support. That's what I'd watch for.
Okay, let's see. LGIH will be your next one. Home construction.
All right, LGIH. Whoops, that's not working. Okay, first off, the home construction group has started to improve. I'm not going to say we're all the way there yet, but definitely we got oversold. We've started to react back to the upside. And with LGIH, you've got a stock that's been outperforming during this move to the upside, outperforming the S&P. And you can see that we've actually been outperforming with home builders as a group or home construction. So I would be looking at a couple of areas. I think this is still viable on the long side. I think it's a pretty good stock within an improving group. So I like the 20-day test here, but if you wanted to try to maybe save some powder, I think there are two areas that I would watch closely on pullback. The last bit of selling stopped at about $54, and then, of course, gap support from this move up in early January is at about 52. Those would be two solid areas as well. But the stock's at 58 now. I think if it goes below the 20, you're probably going to have a chance at these two levels, but there's a good chance it just bounces right off this 20-day.
Okay, let's see. Next one. ENTG, Integris. This is a semiconductor.
All right, ENTG. Yeah, the semis have started to roll a little bit off of that December low. The stock has as well. And look at this on a relative basis. It actually broke out relative to its peers. So this huge volume move to the upside, breaking out above these prior reaction highs, the relative strength, I think all of these things add up to a pretty good argument for a long position on the stock. Now, the question is where to? And I agree with Roman and his comments about the overall market. If the market continues to sell off, we lose some of those support levels we talked about earlier, then a lot of these stocks are going to go down with it. It's just the way the market works. So a couple of key levels I would watch. The first one would be this 20-day moving average, and then these two areas of price support and gap support. I would watch this level as well.
Okay. Next one is in Special Consumer Services Match Group, MTCH.
Yeah, they reported earnings last night. Traders are reacting pretty positively. I don't like the candle, though, at resistance. So you can see the overall group has been declining. Match on a relative basis has been performing very well, but I just don't like the resistance. I think this is a situation where I'd be a seller in the short term. I think what we have is a rally on rumor, and I think we could be getting a sell on the news right at resistance. So I would be a seller of Match here and maybe look to see rising 20-day moving average, maybe down closer to 52 could be re-entry.
All right. Let's see. What do you think of the gold miners ETF, GDX?
Well, the dollar's beginning to strengthen a little bit. So as a result, we've seen gold, some profit taking kick in. And when I look at this chart, actually, I'm going to go in and just, we don't need the relative charts. But let me stretch this out to a year. When you look at it, we are up against some resistance here on the GDX, or very close to it. So if we stretch out the drag this line across price support resistance line from that April high, you can see $23. We got close to that level a couple of times. We just get hit 2270 or so, and we're starting to back off. I think we're in a range on the GDX. So I think to the downside, I'd watch 2150, upside $23. Let's see where it breaks. The uptrend remains in play. I'd start to grow a little bit more concerned if it loses 2150.
All right. And our last one is the communications sector, XLC. What do you think of COM?
I like the 20-day test. I mean, initially, again, I look at the market right now. I'm short-term bullish on this move down. If it holds the 20-day, I think you can buy it and trade back to the upside if the market bounces off of the 20-day moving average. If we lose these moving averages, we can't ignore what we just saw back in December. So I would be keeping very tight stops, but I actually do like the XLC here testing this 20-day moving average. I think you can see here these 20-day tests over the past few weeks have been very good opportunities to get in. So this is one that I'd be watching. I think also you've got some price support. The last high, 45. We pulled back. We went through it. We came down. We just tested 45. So you can definitely make bullish arguments to be long, but this is a short-term trade that I'm talking about. And if it does fail to hold that 20-day moving average, I would be out quickly.
All right. And that does conclude the 10 and 10. Here are the symbols that Tom just annotated. I will have these up in the Market Watchers Live chart list at the end of the show. There you can go ahead and grab them and copy them. Just go to the blogs tab, click on the Market Watchers Live blog, and the link will be right there at the top. All right, time for our final market update. Let's see what's been going on. I have to say, it looks like the markets may have found some support here. They're starting to hit, they've hit their intraday lows and are starting to move back up. But all of the major markets, with the exception of the Canadian markets, are down over 1% right now. So S&P 500 currently down 1.25. NASDAQ is currently down, let's see, 1.5 pretty much. So we're seeing some bad stuff going on in the markets today, not very positive, but it does look like we may have hit some support. We may have hit the low for the day, hopefully. TNX Treasury yields are down 2.668%. The VIX took a spike up toward 18, but has pulled back. It's now 16.93. UUP, the dollar is up slightly. GLD, gold actually having a pretty good day today. I note that between the dollar and gold, they're in the 20-day moving average of the correlation. They're not correlated right now. So I think there is the opportunity for gold to rise despite what happens to the dollar. USO down today over 3% right now. And then we can see TLT is up about 47 cents and reading 121.50. That's all I have for the final market update. Let me go ahead and pass it back to you, Tom.
All right, I just wanted to point out the XLE. This is the worst performing sector today. And you can see the last 2 days have been pretty rough in the group. We were at $65 and change. We've now fallen all the way back down to 62 and change. But we are, once again, this 20-day moving average is going to be like a broken record for me, because when you're trending higher, that rising 20-day moving average tends to act as really good support. As long as they hold, I'm good. But if we start to see breakdowns, especially the more and more sectors that are unable to hold that rising 20-day moving average, I think that could lead to some more technical sellers out there. So something to keep in mind as we go forward. We are now going to move into our final segment of the day, which is Momentum Sleepers. I know I got a bunch, but Erin, what do you have?
Yeah, I picked out 5 that I thought were interesting that I will share with everyone. And the first one is BGG, which is Briggs & Stratton. It's in consumer discretionary household products, which I think is not a bad place to be. Now, it doesn't look so promising right now, does it? We have a little short-term breakdown. The PMO has topped after a buy signal, but I am seeing this is a momentum sleeper in my opinion, because look at those rising bottoms on the PMO, and then we had the declining ones on price, and that's a pretty strong positive divergence that I like. And you can see volume as well is rising on the OBV despite price being mostly sideways here. So I'm looking at this. I would look for that breakout of $13. If you get below that, let's see, right back here, the 12.50 area, down to $12, that would probably be my signal not to, to get out of it and wait for this momentum to kick back into the upside. But I think that this one is a sleeper. We could be seeing some good stuff come out of Briggs and Stratton. HDFC, this one is actually in the financial space. I'm not a huge fan of the financials, but I was a fan of this chart. We're getting a breakout above that $100 range there. You can see I have a zone, a support resistance zone, and we're getting back up into it. And you can see that was a trading range that we had from mid-December into mid-January. So I see that a possibility of a move up to that 104 level based on the PMO is just starting to turn up, and look at OBVs going up. You're getting the scooter rising as well with that short-term rally. Kimberly-Clark, this is in consumer staples. This is an area that I do like right now. And one of the things I really like about this chart, you can see we're getting a 2050. It's actually just barely visible in that thumbnail, a 2050 positive crossover, and that would give me an intermediate term trend model buy. You can see that price did make that nice move up above this short-term resistance, I'd say, at that low we had earlier in January. And now we're pulling back in a big way. And I think that's a good thing. We get back here now to that 5. If we stay above that 50, you've got the momentum starting to turn up. I think this one could be a very interesting one, especially if you've got, if the market starts to go down. I think that this space will be pretty good. We're about halfway through a trading channel though, so keep your eyes open. If you did decide to get into it, I might set a fairly tight stop at about 111. We'll see how that would go, but I think that one looks good. And Primo Water, I thought it was interesting that Roman was talking about utilities and specifically water companies. Of course, this is soft drinks, but at first I was like, oh, good. But it is in that space. I like this consumer staples. Look at the nice positive divergence going on here as well. This is, when you see these, typically you're going to get that bounce and you're going to get a really nice rally when you get these positive divergences on the PMO. You can see it just getting a buy signal right now. So I like this one. I could see it moving all the way up and testing that $16 range, 15, 16, based on this really nice, I think, positive divergence. And finally, Ruth's Chris Steakhouse. There we go. All right, looking in that thumbnail, you can see it a little bit here, but you've got the PMO has done what I call a bull kiss, came down, faked out all those bears of sellers, and now it's starting to come right back up. And I like to see that. It is below the zero line. And I have to say, volume isn't, exactly what I would want to see on the OBV. But when you look at it here, we've had 4 or 5 days here of really nice volume. Not quite above average, but I think it looks pretty good. We've got the move to the upside. 5 is getting ready to cross above the 20. So I think this one could be a good play as well. Not as, I think, as good as some of those others that I did show you, but because we're looking at very strong overhead resistance, I would say, at that 24 level. So we'll have to see where this one goes, but I think this one you could consider a momentum sleeper just because, like I said, that you can see the momentum is starting to turn back. We got the fake out, so we'll have to see what happens from here on out. So those were mine. What do you got, Tom? I know you had quite a few.
Yeah, I've been trying to do more and more of Mary Ellen mode. So I got a number of stocks I want to go over. Before I go into momentum sleepers, and all of these, by the way, are going to be from a short perspective, even though I'm not necessarily going into the shorts. I just think when we talk about momentum sleepers, the stock market had been going down for several months. I think this rally has enabled some of the really weak performers to be momentum sleepers. And if we do turn lower, these are stocks that I believe could take another big turn to the downside. So I'm going to start off showing you a couple that have already done what I'm talking about. One is Tapestry, TPR. This is in the clothing and accessories area. You can see the stock was in a downtrend, bounced. This is what I call the momentum sleeper. The momentum was to the downside, but it actually rallied because the overall market was rallying so greatly. But take a look on a relative basis, relative to the clothing and accessories index. It really was not bouncing. It was simply going up because the group was going up. You look at it relative to the S&P, not good. And then really the overall group has been in a downtrend for a while. So when I look at something like this, I'm always afraid of a company coming out with bad news. And we saw this the other day with Electronic Arts, which I think I'm going to show you in a minute. And I think Anadarko Petroleum may have been the other one. And I think I've got that one to show you as well. But these were two that I talked about before their earnings reports that came out, because they didn't look good. They didn't look healthy. And I think TPR was like that, and you can see what happened to the stock today when they warned. Let's take a look at Grub. They also warned. I think they missed on their top line, missed on their bottom line, warned. The stock gapped down, has come back quite a bit today, and on massive volume. But look at what's happened prior to this. No one should be surprised by a warning and reduced outlook, or a miss and reduced outlook when a stock trades like this on a relative basis. The overall group, restaurants and bars, was nearing the high that it saw back in November. But look at what Grubhub has been doing. It is completely in a shambles. Look at it versus its peers on a relative basis versus the S&P on a relative basis. It's just not a good stock. So when they come out and they miss and they report bad results or bad outlook, you shouldn't be shocked. So that's another example. APC, just maybe 2 or 3 more examples, and then I'll give you some as we go forward. APC, Anadarko Petroleum, this was one that I had mentioned, just didn't look good. Here was the group going down. Here was Anadarko Petroleum going down faster than the overall group. So it's just a bad performer in a bad space. Here's how you can tell that the space is bad. It has been downtrending relative to the S&P 500 all the way since May when it topped. So you've got a bad space, a bad stock, and yet it was going higher. So I think that was a momentum sleeper. Now we're seeing what happens after that. Next up is ADS. Think about how strong software has been. Software nearly breaking out, not too far from breaking out on an absolute basis. On a relative basis, it is still right up among the leaders in terms of outperformance versus the S&P 500. And yet look at the stock, ADS, which is in software, relative to the S&P. It's lagging the S&P by a mile, even though the S&P has been pretty strong and software has been one of the better areas. So what happens? ADS gets hit today. Stock's down over 11%. You got to be careful when these stocks look horrible on the chart and simply get a little bit of a bounce because the overall market is bouncing. I think that can set up a really good momentum sleeper. Electronic Arts, same thing. We saw this one gap down yesterday. And once again, on a relative basis versus the internet, horrible performance going in. The market already knew that there's bad news out. Now they've come out, reported the bad news, reduced their outlook. Actually, the fact that they're still holding above this prior low, I think indicates there's a really good chance that Electronic Arts is in a bottoming process. But we'll see. We'll need to get that breakout above 93 to confirm. But let's take a look going forward. I've got a number of stocks I'm going to go through really fast on what I think could be momentum sleepers to the downside. Cody, stock making a big move to the downside, bounced, really didn't bounce that great considering what the overall peer group did. And so on a relative basis, been absolutely horrible. Wouldn't be shocked to see some kind of bad news coming out on this one. NFX. This is in the oil patch. Big move down, nice little bounce, starting to roll over today. And you can see on a relative basis, just been really weak. So, as I go through, just keep in mind, I like these charts going up from left to right. When I see them all going down from left to right, it's telling me I'm in a bad space and I'm in a bad stock within that space. And that usually leads to bad news. DVN up next. You can see Devon Energy, same thing. A number of these are energy stocks, by the way, starting to roll over, not looking good. And again, on a relative basis, very, very weak. FLR, which is Fluor Corp, another one that had gotten hit hard, has bounced back. This is in the industrial area. But on the bounce back, you can see really just no relative strength versus its group. So, yes, it was moving up, but it was only moving up because the overall group was moving up. It wasn't doing anything on its own. And as a result, once that buying, that inflow, the money coming into the market subsides, that's when you start to see a stock like FLR moving lower. NBL Noble is another energy company, and I don't have to show you, but you can probably picture it here. Everything moving down from left to right. APA, which is Apache. Apache also in the oil patch. And once again, rolling over. Look at the relative weakness, not good. And then just three more. MHK, this is Mohawk. This is in furnishings. Furnishings actually had a pretty good January and kept moving higher into early February. But Mohawk, after being absolutely crushed, has not been able to get back through 130, 132 area. I would be looking for something else bad. Another shoe to drop here on MHK. PXD, another one downtrending, again in the oil area. Weak stock. If I was going to get into oil, I want to get into stocks that are outperforming their peers, not stocks that are underperforming. Tiffany's in the specialty retailers. Look at this huge bounce back in specialty retailers, and look at this lethargic bounce in Tiffany's, meaning on a relative basis, the stock continues to drift lower. Not good. And the last one, AMG affiliated managers. You can see also downtrend, move back to the upside, but that's because the overall group bounced a little bit, still continuing to downtrend relative to its peers, relative to the S&P, and asset managers have been horrible. So you got a really bad group and a really bad stock within it. Don't be shocked to see some bad news coming out of AMG. So those were my momentum sleepers, a little different approach, but using relative strength. I think this is one of the most important tools to use in technical analysis. Be very careful buying stocks that are not in favor on a relative strength. Market knows a lot more than we know. And so if they're getting information suggests they should be getting out, maybe we should be getting out too.
There you go.
All right. So that is it for the momentum sleepers. Went through a bunch of them. I tried to make Mary Ellen proud with that. Went through them as fast.
I'm sure she would be.
Yeah, I think so.
All right, Tom, there were a few questions. I know we only have a second or two, but people wanted to know if you know who decides which companies report when. Is it self-determined? Is it the SEC?
It is the SEC.
Okay.
I've been out of public accounting for quite a while, but when a company goes public, it's required to follow the SEC rules, guidelines.
Mm-hmm.
It's not voluntary. They're mandatory. So I know when I was in public accounting, the SEC required public companies to file quarterly reports within 45 days of quarter end and 90 days of year end. But I'm pretty sure that was changed about the time I got out of public accounting. And I think that it was lowered to 35 days within quarter end and 60 days within year end. And there's also a limitation based on the size of the company. So they give the smaller companies a little bit more of a break. But I'm pretty sure the numbers I just gave you, the days and all, apply to companies with a public float. I want to say 75 million or more, but I'm kind of not, maybe it was 100 million. I'm not sure. But public float are all of the outside shares owned times the share price. So that's essentially the market cap of those outside shares. So if it's more than 75 million, or maybe it's 100 million, then those rules I talked about apply. Otherwise, I'm not sure what the rules are if they're smaller.
All right, we're getting ready to close out, but maybe you can think about this for tomorrow. What's your wisdom on how buybacks and market makers are related?
That's a good question. One I really don't know the technical answer to. I imagine that it's similar to an institutional buyer that wants to buy back so many shares. They probably go through a market maker, and a market maker acquires the shares for them.
There you go. Great show. I know that you and Mary Ellen will have a great time tomorrow.
Yeah, we always have a good time, and I know she'll have plenty to talk about, especially with a reversal here. Might have some hot and some not stocks to talk about. You have a great show tomorrow as well.
Thank you.
We'll see you back here on Monday. Want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everyone. We'll see you back here tomorrow. Happy trading.